small and medium scale enterprises are riskier than very large enterprises. So the banks are going to have to take a decision and say, look, I know I'm going to make more money from small and medium scale enterprise because they're riskier, and then I price in their risk, and then my books look quite nice, and I can declare good dividends to shareholders. However, do I want to take on that risk? Or should I lend to some of the big boys who can negotiate better interest rates, so I have lower margins, but
You're welcome to this special WebTV session, where we'll be looking at the United Bank for Africa's full year 2025 and first quarter 2026 results and what the market should expect further. I'm Otto Abasi. I'll be having this conversation with Mr. Teslim Shitta-Bey, Director of Research, Proshare. It's great to have you.
It's a pleasure being here with you, Otto.
As market developments come like that, we just continue to look at it and dig it out, yes. So our viewers, United Bank for Africa Plc released its audited full year 2025 financial results after the close of trading on Friday, 25th April 2026, alongside its unaudited first quarter 2026 financial results authorized by the Board of Directors on the 24th of April 2026. The outcome has generated active market debate. UBA remains one of the systemic banks that constitutes the FUGAZE cohort identified in the Proshare Tier 1 bank report. The headline reading of the full year 2025 results invites a skeptical first response. The profit after tax fell by 47.21% to 404.70 billion naira. The cost of risk rose to 4.17% on a 331.07 billion naira impairment charge taken under the Central Bank of Nigeria forbearance exit. The cost-to-income ratio climbed to 59.39%, and the proposed final distribution to shareholders is materially lighter than the cycle that followed, and 395 billion naira rights issue placed at a premium to market would have led some participants to expect. This special session discusses what investors should now expect from the bank, the cohort, and the regulatory regime under which the cohort now operates. And it draws on two Proshare publications, the Analyst Note of 26 April 2026 titled UBA's Full Year 2025 and First Quarter 2026 Trajectory, Normalisation of Earnings, and the Reset Beyond the Headlines on Provisioning, FX Cost, Distributions and Stock Price, and the OpEd of 27th April 2026 titled Investment Returns Under the New Banking Regime. So let's get on to this conversation, Mr. Teslim. First, we'd like to get the understanding around the headline reset around this whole development.
Thank you, Otto. One major thing that I think, and as a research organization, we think actually, is that there was no very deep understanding of the implications of the bank capitalization process. Now, the bank capitalization process was designed to ensure that banks were adequately capitalized. Then the question is, why? Why are we concerned about their capitalization? Now, one of the major problems that have been identified by the CBN is that many of the loans granted by these banks were impaired, means that some of these loans were not likely to come back. And in such a situation, you want to ensure that the banks have enough capital to serve as a buffer. Now, was that going to have any implications for the banks? Yes, it was going to have implications because the CBN had engaged in what we call in Nigeria forbearance. What that means is that the banks had the challenges of the loans. They needed to make provisions against those loans, but those provisions were not charged to the profit and loss account immediately. So that's where the CBN forbeared and said, okay, we'll give you time to do that. And those loans kept growing and growing, and unfortunately, some of them got pretty large. So when the CBN, in its wisdom, decided to recapitalize those banks to ensure that there was adequate capital for all the banks, they took that into consideration, forbearance. One of the critical things was that you recapitalize, but you're going to have to take care of your forbearances. And that's one of the things that we've seen play out in the market more recently, where banks now make those provisions for those poorly performing loans, or even as a matter of fact, even lost loans. They've made those provisions for them currently. That was definitely going to put pressure on their profit. And in putting pressure on the profit, it was also going to adversely affect dividend payouts. Those were inevitable outcomes that I think most analysts and perhaps a few investors understood.
And now let's look at the next part of this conversation. You've now laid the premise around the whole issues of the recapitalization and the impact it's had on the UBA, because there's been a general market debate, but what Proshare does is we look at the issues, we set the facts and around the conversation. So the next part of this, as we look at this very interesting development, is the two identifiable items in that whole conversation. The reconstruction of the full year 2025 strip out of two specific items, the impairment charge, and of course the aggregate derivative and foreign exchange related reversals. How does this impact the UBA and of course indeed?
As I said earlier, one of the things that you do as a bank is to make provisions against poorly performing loans. Historically, Nigerian banks have made provisions, but not adequate provisions against such loans. So maybe, for instance, you are supposed to make a 1 million naira, just say 1 million naira provision, and you actually say, you know what, we need to add value to shareholders. So what we will do is just do a provisioning of 500,000 naira, and the other 500,000 naira goes to share in terms of dividends to accruable to shareholders. So there was an under provisioning. So what has happened now is that CBN has taken that in and said, you know what, we are going to forbear. But the forbearance won't be eternal. Okay. There will be a limit to that forbearance. So what we're going to do now is we want to clean the system up. So what we are going to do is to ensure you recapitalize. And once we are confirmed that that capital base is adequate to absorb the forbearance, then you take that forbearance in full. And that's precisely what we've seen now. So the impairments actually, that's an accumulation of under provisioning that's occurred over the years. Yeah. Now, when we look at the FX, 2024, we saw that very many banks actually had foreign exchange gains. And that was related to the 2023 actions of the federal government to harmonize the exchange rates between the official market and the unofficial market, or the BDC market. That saw a major increase. So you imagine you had $1 million as of maybe April 2023. Then suddenly a new government comes into power. Now at that time, you're looking at about 400 naira to $1. Then suddenly the rates go way up there. And then you see yourself with maybe 1,600 naira to $1. And you see yourself making about 1,300 naira extra. And that's why the CBN warned that, look, don't take this windfall and start distributing it as dividends. So that you've got to hold on, wait, because a reversal will definitely come. When the exchange rate stabilizes and there's a normalization of the exchange rate, then there's going to be a reversal, and that reversal will hit you the other way. So while it was a gain at one point, it's going to be a loss at another point. So those are the kind of accommodations that we saw in the sector and amongst cohorts. So it's not just a UBA thing. It's like you rightly pointed out, it's a systemic, it's a cohort thing. The FUGAZE, like you said, tier 1 banks, obviously we're going to have large amounts of FX recalibration as a result of that, because they also made heavy FX gains during the 2024 period. So the reversal of those gains will also be very heavy on them. And those are the things that we are seeing cleaning themselves out within the system. It's not time for panic stations, but it's time for circumspection. The gains are not now, they're forward. So when we take a forward look at how the bank's reports will play out, we think that there will be more stable pronouncements concerning their comprehensive income statements. And then we also believe that their balance sheets will look a lot healthier. So yes, they're all taking a hit now, but the hit is not permanent, right? It's a what we call a retracement. What it means is that you're correcting for past behaviors. And that shouldn't really, shouldn't incite too much concerns on the part of shareholders and investment analysts. Yes, there is an immediate concern, and we've seen the immediate response. You've referred to that. When we look at Monday, we saw a 10% discount on UBA, for instance. Tuesday, which was yesterday, another 10% discount on UBA. But don't forget, at the beginning of the month of April, we're looking at 46 naira per share. Was 46 naira. So it suddenly ratcheted up to 55 naira by Friday, the 24th. And then we now started seeing that when the results came out over that weekend, the market instinctively responded. And I think that was made a bit worse by the fact that there was no payment of dividends, but that's another conversation entirely.
Yes. So looking at the concerns around dividend, what's critical at this time? I mean, a lot of people participated in the rights issue, expecting that they will have a dividend at this point. So the Proshare OpEd published, talked about the investment returns under the new banking regime, and it highlighted that challenge, of course, and expectation. So looking at the BOFIA and all the provisions, talk us through the regulatory architecture and why UBA chose this path at this time.
Like I said before, the CBN had looked at the overall system, looked at the fundamental weaknesses within the system, okay? And it decided that, you know what, we have to call a period where we're going to cut off all this baggage and say, you know what, we're cutting off the baggage, dumping it in the archives of history. And then we recalibrate and start a much more transparent, a much healthier banking environment. And that's what has happened. So quite honestly, the UBA decided not to pay a dividend was consistent with the regulations, because one of the aspects of the regulations was to assess the size of your capital to the extent of forbearance. Yes. So if your forbearance was large relative to your capital size, CBN saying you're not paying any dividend because you've got to get your books straightened out. And it takes courage to do that, but it's the right way to go. You've taken a hit, cleaned up your books, and now you're free to move forward, right? So don't forget, your UBA declared profit, 404.7 billion naira. So it could have jolly well declared the dividend from that, but it decided not to and engaged in retention. Now, engaging in retention is saying that, look, you know what? Yes, we've taken a hit of 331 billion naira. We've cleaned up our books. So instead of saying we're around maybe 761 billion naira, we've taken a profit of 404 billion naira. Now we've cleaned up the books. Now see this 404 billion naira, we're going to put it back into the system, use it to create loans and advances of a tidier nature. And then now the returns from that comes into the system that is now distributable at the end of the year. So for us at Proshare, H1 2026 is a critical aspect of reviewing the issues around UBA. Because from what you discussed earlier, we've already seen that the cost of risk has dropped from just over 4% to 2.02%. So that means that, okay, so the cost of risk is coming down. We've seen that pattern. Will that persist going into half year 2026? But there's something you didn't mention, and that is where the true concern for the shareholders should be, is actually the 59% cost to income ratio of the bank. Because that cost to income ratio is crucial. The bank needs to get on a trajectory where it can push that down, you know, so that we'll see greater amount of efficiencies in the use of its resources. That, for us in Proshare, is the critical issue. The cost of risk is going in the right direction. So we're seeing that come down. Now, we will talk about this perhaps later, where we're looking at the risk-weighted assets of your UBA. So for us, the architecture of regulatory environment has shifted from looking at top line revenue issues to looking at quality of capital and quality of loan assets. So unlike the CBN of the past, where it was about, oh, okay, let's see how much money these guys made. The new CBN is looking at what kind of money did they make? What's the quality of the loans they're providing? And are those loans based on risk-weighted assessments? Are they properly capitalized? Do they have proper capital buffers? So that if those loans go bad, the bank has enough capital. So we're seeing a subtle but important shift in the regulatory architecture.
Yeah. Very interesting insights. Now let's look at the first quarter 2026, the signals. What will we say around the signals and what is showing based on what Proshare has also been able to deduce from them? Looking at the cost of risk moderated to 2.02%, the return on equity lifted to 13.70%, and of course the loan book growth of 2.10%. But looking at it overall and based on what has happened Monday and Tuesday, what will you deduce as it has to do with other banking stocks and the industry?
There have been obstacles. Getting recapitalized has been an obstacle. Cleaning up your loan book has been an obstacle, but that's the way. Being able to overcome those challenges strengthens you as an institution. And that's what we see in Q1. And that's why I said that when you look at from over 4% cost of risk, you're coming down to 2.02% cost of risk. That's the way. Okay? But there are still problems. And the problems exist in the areas of cost of operations. And I think investors will be interested in seeing that improve. That's why I say we need to ease into H1, that's half year, and see whether the bank has been able to manage those costs more efficiently than they have in the previous quarters. But generally speaking, not only UBA, because there's also, people keep seeming to forget that there's also, you talked about FUGAZE. There's one bank in that FUGAZE that hasn't released its report.
And we're still waiting for it.
Yes, they're still waiting for the report to be released. We thought it would come out yesterday, but it didn't. And one of the challenges is that issues around declaration of dividends. They've seen what has happened to Tai. So Kinde is a bit more is a bit more circumspect. So these are issues that will occur, you know, based on first quarter assessments, year-end assessments. You want to take a strategic look at, do we or do we not provide shareholders with more value at this challenging period? It's a transitional period. And I think that's important for everybody to realize that it's a transitional period for the banks. Those transitional periods will come with transitional costs. Non-declaration of dividend is part of that cost. However, it's hard on those who want to earn income. Yeah, it's hard on them, but it's not permanent. It's a temporary blip. You know, I mean, one goose, right? One goose does not make a swarm of geese. So it's as simple as that. There are periods of times where regulatory actions may result into these kind of blips in performance.
So let's look at the what you said you were going to discuss much later, the risk-weighted assets, the capital quality, and of course the path to a lower cost-income ratio. If you want to speak to that in the next 1 minute.
When you're looking at risk-weighted assets, what you're looking at is your loans and advances and what risks are associated with that. For instance, if I'm a bank and I put my money in treasury bills, the risk associated with that is zero. I'll collect my money, right? I'm sure. But when you put your money in, let's say, Auto Abasi Enterprises Limited, you know, my risk assessment will be much different. Some institutions had large exposures to oil and gas sector, and they also had large exposures to the energy sector. Those two sectors have shown themselves to be quite risky, right? So when you look at that, you say the risk weighted, because I'm going to take the average, right? So I'm going to take the risk on that, my operational risks. I'm going to look at my operational risk and then sum that up, right, with my credit risk. So you come to what we call the RWA, risk-weighted assets, right? So you take all those together. Now, operational risks we've seen have risen gradually across the cohorts, across different banks, particularly tier 1 banks. We've seen that, and that's basically tied to technology expansion, going outside the shores of Nigeria to expand into new markets. So that has also put pressure on costs. And we've seen that with UBA. And that's why I said that you see UBA having those cost to income ratios rising over a period. That will normalize. Because as you enter into those new markets, you're looking at new opportunities. You perhaps get risk assets that are of a good quality, and you have diversified away from the exposure to a single currency, the Naira, and a single economy, the Nigerian economy. So there are a lot of those risk factors that will temper down the overall average cost of risk for the bank. So like I said, these are early days and it's transitional. So we see those kind of things happening. You're seeing the cost to income ratio a bit on the high side, not for every bank. Yeah, but for a few of the tier 1 banks, we've seen that happen. We've also seen risk-weighted assets high, relatively high at the end of 2025, but they're declining. We're seeing an indication of decline in Q1 2026. We're hoping that continues, right, into H1 2026. And that will settle down nerves of investors that, okay, fine, we're beginning to normalize and do a reset towards what it was before the recapitalization exercise. Yes.
Very, very interesting. Now let's look at the new investment return framework. Very interesting OpEd by Proshare. And it argues that what once qualified as a banking investment return, a predictable annual cash distribution in terms of backed by reported earnings, has been replaced by a layered framework in which capital quality, regulatory clearance, recoveries, optionality, and stress testing outcomes all sit ahead of the dividend check.
Excellent. Let's put it this way. The most regulated industry in the country today is the financial services industry. And rightly so. Because of people, yes, and rightly so. People may disagree, but it needs to be regulated, right? There has been a bit of a liberal approach to banking sector regulation in the past. And that's why we had these large forbearance. Large institutions had large forbearance. Now, this central bank says, we're going back to basics. Those days are over. If you're lending, the quality of those loans are important to us as a regulator. We're not going to allow you to begin to lend money in a fanciful manner, regardless of the relative risk of such loans. So that will have an impact on the returns investors will see. If you noticed, UBA's loan growth have been slow. And when you look at the bank's deposit ratio to its loan asset books, you find out that it's blown up. And if you put it the other way, it's actually come very much down. If you reverse it, it's come very much down. And that's because banks are now more circumspect in lending. That could have layered implications. For instance, small and medium-scale enterprises are riskier than very large enterprises. So the banks are going to have to take a decision and say, look, I know I'm going to make more money from small and medium-scale enterprise because they're riskier, and then I price in their risk, and then my books look quite nice, and I can declare good dividends to shareholders. However, do I want to take on that risk? Or should I lend to some of the big boys who can negotiate better interest rates, so I have lower margins, but there's greater security in my money coming back? So at the end of the day, I make lower profit, I can distribute lower dividends, but I'm more secure in terms of the quality of my risk assets and the size of capital I need to bring in to protect those loans and advances, So it's a tricky situation, to be honest with you. To grow the economy, we need to put money into SMEs. It's the largest sector of the economy, right? Half of the economy, more than half actually, is associated with that sector. So you want the banks to lend to that sector, but it's risky. So banks are going to have to establish within their internal frameworks whether we want to go and say, okay, you know what, this 650,000 barrels per day plant, scaling up to 1.5 million barrels per day, that's where we're going to concentrate on. It's safe. We know the assets are there, protecting us. We also know the managerial experience is there. And therefore, interestingly, the man says he's also going to East Africa, another 650,000 barrels. So why don't I join the party? Yeah. I scale with safety. But I could make more money scaling with less safety. So banks are going to be within that framework. And I think returns are also going to reflect that. So the architecture of the loan book will shift. And those shifts will determine those banks that will declare more profit and distribute more dividends. So I think that's what basically shareholders will look at.
Looking at the cohorts now, other banking players, what is a big lesson in terms of this whole playbook, as we've seen from the UBA and based on the OpEds from Proshare, as we look at the whole developments and additional ones that will come out to declare result awaiting CBN clearance?
Truth of the matter is that all banks are subject to the same CBN regulation, right? And therefore, but the impact will be differential because each of them have chosen in their wisdom to operate within certain frameworks that are layered. Let me give you an example. You take a GTCO, high return on equity, relatively lower segment adjustments, especially in the SMEs, but high corporate lending, relatively lower retail lending. And then you take a Zenith that has high levels of commercial transactions, especially that are export-facing. These export-facing transactions, you see a lot of high. So risks are going to be different. And the mix of how I'm going to accommodate those risks will differ according to the preferences of the different banks. Or not only the preferences, but also the expertise of the different banks. Okay? Because if you look at it, let's take a look at it in terms of markets and market discounting of value of the different banks. When UBA went down 10%, GTCO went down just 4%. But at the same time, you saw a situation where Fidelity went down 10% too. You know? So some of the banks that the market felt had forbearance of a relatively large nature went down heavily in single-day transactions. So for 2 consecutive days, we saw UBA go down 10%, 10%. In Proshare, we think that will thin out as there's less anxiety and greater understanding of the challenges that resulted in them not declaring dividends. We think the dividend issue was exaggerated, not for income-dependent investors, because understandably, like you said in your intro, they had just spent money on their rights, and spending money on their rights meant that they were expecting that those returns would come pretty fast, right? But there's a difference between short selling and investing. A short seller is looking for immediate returns, right?
But
so one of the
investing
things
is long term.
Investing is long term. So those investment horizons need to be made clear to investors by capital market operators. Investment is a medium to long term proposition. But if you want to trade, yes, that's short term. And the guy who's doing the rights, I would recommend, and perhaps my colleagues will also say the same thing, they can trade their rights. You have a right to trade your rights, so you can trade your rights. So those guys who are investors and are prepared to provide patient capital can do so.
So as we close, what is the single most important message Proshare wants viewers to take away from this conversation, both about UBA and specifically about the new banking regime more generally? And of course, what should investors, regulators, and policy-aware market participants be doing differently in the days, weeks, and months ahead? And if you could speak to the next 2 quarter cycles, what should we anticipate from this?
Well, I think short sellers that decided to play the market are in the bank smiling, because they understand that UBA fundamentally is a top-tier bank. There's no fundamental challenge in its operations. It's cleaned up its book. It's a cleaner bank today than it was last year. So the underlying value of the bank will be shown in subsequent results that it produces. We expect to see some significant improvement going into 2027. We expect to see significant improvement. That's why I say H1 is a bellwether report, because we want to see whether it feeds off the improvements we've already seen in the first quarter of the year. So if it does, then we believe that year end will be a much more favorable year for investors to show dividend payouts. Even though I do want to say that investors' expectations should be moderated by certain realities. Now, why I'm saying that is this. A large quantity of shares have been bought by investors, which means that large quantity of shares has reduced the earnings per share of UBA. Now, if you use the earnings per share as a tool for calibrating value of the company, then UBA will not rapidly get to where it was prior to the recapitalization. There's need for patience. for them to be able to use the new capital they have and grow the business. And at that point, yes, we should be able to see sustainable returns on investment, both in terms of dividend yields and capital appreciation. The two will grow significantly. And that also applies to other banks. Yes, because the truth of the matter is lower earnings per share suggests lower dividend per share. Investors need to understand that. The fact that you put money into the bank, it's not a casino. People need to take that money, turn it into earnings, from which you can now pay dividends. Okay, so that will happen, but it will take time to happen. So Proshare urges patience, resilience. Like I said, perhaps the obstacle is the way. Now we've crossed the obstacle. Let's just follow the way to the land where returns are much more exciting. And that is possible. And you know why it's even better is that unlike front loading, which is what happened, let me just quickly mention this. What happened was that there was a front loading of price. If you look at the speed at which UBA got to 55 naira from 46 naira, everybody was saying, okay, so that means that there's something fantastic that's going to happen in the results. The results were, quote unquote, underwhelming. No dividend declaration. Then from maybe an expected 7.6 was there about 760 million naira profit. They went to 44.7 billion. Billion, yes. So people were like, what's happening here? We saw the price move and we wanted to cash in on that momentum. And suddenly we're seeing this kind of result. No dividend, no capital appreciation. Look, and then so the market decided to punish the institution for front loading, for no fault of theirs, because the front loading was from investors. And perhaps, I don't know, but perhaps because short sellers wanted to take positions. And so we started seeing what we're seeing this week, where short sellers have been pushing the price down. Because if you look at Monday, there was no bid. There was no bid for UBA. But offers was close to, I think it was 340 million shares available for offer, and there was nobody picking it up. So obviously we expected that Tuesday, that overload that we saw on Monday will feed into Tuesday and we'll see a 10%. And we called it that there will be another 10%, and it happened. And that might happen gradually throughout the week, but it will cool off. It will cool off. Yes, it will cool off. There will be a retracement and it will cool off, and then everybody should be settled. And they'll settle down. There will be less anxiety, and hopefully by H1 we start seeing the old UBA we were known to see, show brilliant results. And I think that will also happen for all the cohorts actually that you talked about. They all might see some challenges in this window, but by H1, it's not yet a huru. They're going to work really hard because that new capital that they got in is not a freebie. I keep telling people that equity is even more expensive than debt because you've got shareholders who are waiting and they're expecting some decent returns. So you've got to sweat that capital. So that capital is going to have to sweat. So UBA is going to sweat. And at the end of the day, Nigerians, investors across Africa will be better for it.
Yeah. So the industry has to sweat and ensure that there's return on investments and value. Thank you very much, Mr. Teslim Shitta-Bey, Director of Research, Proshare, for this interesting conversation, looking at the United Bank for Africa full year 2025 financials, and of course the first quarter 2026, and what the market should expect from a wider banking industry activity. Thank you once again.
Thank you very much for having me.
Thank you. This has been an enlightening session discussing United Bank for Africa's PLC's full year 2025 financial results alongside its unaudited first quarter 2026 financial statement results with Mr. Teslim Shitta-Bey, Director of Research at Proshare. Our viewers can log on to our website and follow our social media platforms for further updates. The two Proshare publications referenced in today's conversation, the Analyst Note of 26th April 2026 and the OpEd of 27th April 2026 titled Investment Returns Under the New Banking Regime, are also available on the Proshare website. Also follow our stock recommendations every Monday and offers on the market on Tuesdays to get further insights on what's happening in the markets. Till we come your way again, just to let you know that very soon Proshare will be releasing its Tier 1 bank reports. Watch out, follow our platform to get further insights. I'm Mutoba Sebaseko. Thank you for watching and bye for now.